Famous investor and Vanguard founder Jack Bogle once said, "The greatest reward investment can give you is freedom." And what better way to let your money work for you and give you freedom than by building a monster dividend portfolio? Many investors dream of creating a stock portfolio that provides enough passive income to cover all of life's expenses. But is it actually possible to generate $20,000 per month in dividends? With the right strategy and patience, the answer is yes. In this video, we'll walk you through the step-by-step process for building a monster dividend portfolio. Whether you're a seasoned investor or just starting out, get ready to learn the essential strategies, tips, and tricks that can transform an ordinary portfolio into an unstoppable dividend income machine. We'll examine exactly what to look for when selecting strong dividend-paying companies to anchor your portfolio. You'll learn how to structure a diverse portfolio across various sectors and industries to maximize stability and growth. Most importantly, we'll share the common mistakes that trip up beginners and show you how to avoid them. If your goal is to construct a portfolio that not only provides steady income, but also has the potential to grow your wealth dramatically over the long term, you won't want to miss this deep dive tutorial. Let's get started building your own monster dividend portfolio, one that can realistically earn upwards of $20,000 a month in dividend income alone when properly structured. Step 1. Understand how dividends work. Dividends are regular cash payments that many companies pay out to their shareholders. When you own shares in a dividend-paying stock, you are entitled to receive a portion of the company's earnings. For example, if you own 100 shares of a company and its dividend rate is $1 per share annually, you would receive $100 per year in dividend income. As a company generates profits and grows over time, it can choose to increase its dividend payments. When dividends are reinvested to buy more shares, this begins compounding where you earn dividends, not only on your original investment amount, but also on the shares accumulated through reinvesting. Over decades, even modest initial investments can snowball into a large portfolio with greater dividend income potential. Step 2. Determine your monthly income goal. To build our monster dividend portfolio and generate $20,000 in monthly income, we first need to establish this goal. While $20,000 per month in dividends may seem unrealistic for smaller portfolios, remember that through the power of long-term compounding growth, portfolios generating this level of passive income are reachable. When setting your monthly dividend income goal, be sure to consider your estimated monthly expenses in retirement as well as an extra buffer. A lofty goal will motivate you to implement a rigorous savings and investing plan. Step 3. Estimate your required portfolio size. Now that we know we want to achieve $20,000 in monthly dividend income, we need to estimate the portfolio size required to generate this level of income. A conservative rule of thumb is to have a portfolio value of 25 times your desired annual income from dividends. So if we want $20,000 monthly or $240,000 annually, we would need to build a portfolio worth roughly 25 times $240,000 equals $6 million. This $6 million portfolio value will provide our income target while allowing room for dividend growth to combat inflation. Step 4. Calculate your required savings. Saving and investing enough to build a $6 million portfolio capable of generating $20,000 in monthly dividends is no small feat. But with consistent savings and compound growth, it's very achievable over a couple of decades of investing. Let's assume we have 30 years to build this portfolio and can achieve a 10% average annual return through a combination of dividend growth and share price appreciation. To accumulate $6 million over 30 years with a 10% return, we would need to save about $1,300 per month. While this level of savings may require sacrifice like budgeting expenses and avoiding lifestyle inflation, it's manageable for many incomes. The key is starting early so compound growth can work its magic. Waiting too long requires much higher monthly savings to reach the same portfolio value. Step 5. Select higher quality dividend growth stock. Now it's time to put our savings to work. To build our monster dividend portfolio, we need to invest in high quality stocks with these characteristics: history of consistently raising dividends, healthy dividend payout ratio below 60%, managing debt levels, competitive advantages over peers, track record of revenue and earnings growth. A few great examples fitting these criteria are Johnson & Johnson with 58 years of dividend growth, PepsiCo, 49 years of dividend growth, Texas Instruments, 18 years of dividend growth, Home Depot, 12 years of dividend growth, Broadcom, 11 years of dividend growth. Focus on blue chip stocks with durable competitive advantages that enable them to grow dividends over time. Patience and persistence are key. Stick to the long-term plan. Step 6. Reinvest all dividends. As our holdings start paying dividends, it's critical to reinvest all of them back into acquiring more shares. A dividend reinvestment plan, DRIP, automatically uses dividend cash flows to purchase additional shares. This turbocharges the compounding process, accumulating more shares, which in turn generate greater dividend income. Thanks to reinvesting, a $10,000 investment earning 6% dividends could grow to over $70,000 in 30 years. That's compared to just $28,000 if dividends are taken as cash. Step 7. Diversify across sectors. While we want to focus on high-quality dividend stocks, it's crucial to diversify across market sectors to reduce risk. Build positions in stocks from these sectors. Consumer staples sectors: PepsiCo Incorporated, ticker symbol PEP, Johnson & Johnson, ticker symbol J&J. Information technology sector: Texas Instruments, ticker symbol TXN, Broadcom Inc., ticker symbol AVGO. Industrial sector: United Parcel Service, ticker symbol UPS, Honeywell International, ticker symbol HON. Financial sector: JP Morgan Chase, ticker symbol JPM, BlackRock Incorporated, ticker symbol BLK. Healthcare sector: Pfizer Incorporated, ticker symbol PFE, Amgen Incorporated, ticker symbol AMGN. Diversification smooths out volatility and protects our income stream. Step 8. Continually invest your savings. As time passes, continually invest your money savings into the portfolio. Regularly injecting fresh capital and reinvesting all dividends will compound growth. Periodically rebalance the portfolio weights to maintain target sector allocations and manage risks. Trim overly large positions and direct the proceeds into lagging stocks. Step 9. Remain flexible and patient. On the journey to building our $6 million portfolio, be flexible and make adjustments when necessary. For example, if a stock cuts its dividends, replace it with a new qualified dividend payer. Stay patient and remember this portfolio is designed to fund decades of retirement. Short-term underperformance is expected. The long-term compounding nature of dividend reinvesting and regular savings contributions work wonders over time. Step 10. Manage withdrawals in retirement. Once retired, our priority is preserving the portfolio balance so it can continue funding our dividend income long-term. Annual dividend income can generally be withdrawn at 4 to 5% rate without depleting the portfolio. On a $6 million portfolio, this equates to $240,000 to $300,000 annually, supporting our $20,000 monthly income goal. During prolonged market downturns, temporarily reduce withdrawal rates to give the portfolio time to recover. Also, prune underperforming stocks and redeploy capital to keep driving dividend growth higher. Stay invested. Don't attempt to time the markets. Stick with the plan, and the power of dividend compounding will continue to work its magic.